Welcome to Talk Tickers. Today, we're diving into the latest earnings from Agilysys, that's ticker AGYS, and boy was their third quarter report a wild ride. Let's get into it. All right, so here's the big question, right? Agilysys comes out with its 16th consecutive record revenue quarter. I mean, that sounds amazing. But then the stock just falls off a cliff, plunging 14%. What in the world happened? That's exactly what we're going to unpack here. The massive disconnect between what the company said and how the market reacted.
Okay, so let's get right to it. What were the headline numbers that sparked all this drama? Let's take a look.
And here you have it. This is the classic beat and miss scenario. On the revenue side, things look good. They brought in $80.4 million, beating the consensus of about $79 million. That's a solid win. But then you look at the adjusted earnings per share. They hit 42 cents, but Wall Street was looking for 46 cents. And that little 4-cent miss, man, that turned out to be the one thing the market absolutely fixated on.
This chart really paints the perfect picture of the whole situation, doesn't it? You've got this great news on revenue, a clear beat, but it's completely canceled out, overshadowed by that miss on earnings. It's like it created two totally different stories. And as an investor, you're stuck in the middle wondering, okay, do I believe the growth story or do I worry about the profit story?
Okay, so first, let's look at this from management's perspective. Because if you listen to them, everything is running full steam ahead, they're super confident, super bullish, and they're really trying to get investors to focus on the big picture.
And the CEO, Ramesh Wadwani, he really set the tone on the call. He used this phrase, a relentless, well-oiled machine. I mean, that's some strong language. The message he's sending is crystal clear. Hey, don't sweat the small stuff from one quarter. Look at how we're operating. We are absolutely crushing it.
And you know what? He's got some pretty compelling numbers to back that up. Yeah, we talked about that 16th record revenue quarter, but check this out. Their subscription revenue is up a whopping 23.1% year over year. That's huge in this space. They're so confident, in fact, they actually raised their full-year revenue guidance. So from where they're sitting, everything looks fantastic.
And then there's the big one, the ace up their sleeve, really. That huge project with Marriott. Management was quick to point out that the pilots are done and they're moving into full-on implementation waves. Now, this is a potential game changer for them, a massive future catalyst. And the key thing to remember, none of that future money is baked into their sales numbers or their guidance yet. It's all potential upside from here.
Right. So management is painting this beautiful long-term picture. But the market, well, the market is impatient. It's focused on right now. And while management was talking up their well-oiled machine, Wall Street heard something, well, something that sounded a lot more like a reality check.
And here's what that reality check looked like, a 14.4% drop. What's crazy is that the stock was actually up over 5% during the regular trading day. People were optimistic. But the second those earnings numbers came out after the bell, boom, it just fell off a cliff. A really brutal turnaround.
So you might be asking yourself, why would everyone panic over just 4 cents? Well, here's the thing. An EPS miss, even a small one, can be a huge red flag for investors. It immediately raises questions about profitability. Are costs getting out of control? Are their margins getting squeezed? It plants a seed of doubt that can override all the good news about revenue. Because at the end of the day, what good is bringing in more money if you can't keep more of it as profit? That's the question that traders were asking.
And this slide just crystallizes that whole conflict. It's like you're looking at two different companies. On one side, you have management story. It's all about growth, subscriptions, that huge Marriott deal, the future. On the other side, you've got the market story. And it's all about the present moment, the EPS miss, margins dipping just a bit, basically short-term profitability. It's a classic tale of long-term vision versus short-term reality.
So, you've got these two powerful forces pulling the stock in opposite directions. Where does it go from here? All right, let's get into our take.
We're going to break this down into 3 simple parts: what we see for the next quarter, how we think the stock will behave, and then our final rating.
First up, the outlook for Q4. Now, if you just look at the raw numbers, their guidance implies that subscription growth is going to slow down to about 20%. And at first glance, that looks a little scary, right? But management gave some important context here. They said that's only because they're up against a really tough comparison from last year when they had a big acquisition. If you look at the core organic business, they say it's still growing at a really strong 25%. So, what's our forecast for the stock itself? Well, get ready for a battleground. This stock is going to be caught in a tug of war. You're going to have the bulls who are buying into that long-term growth story and that massive Marriott potential. And then you're going to have the bears who are selling because they're worried about the profitability right now. We think this means the stock is probably going to be pretty volatile, stuck in a range until one of two things happens. Either we see real, tangible revenue from that Marriott deal, or the company puts those margin concerns to rest in a future quarter.
Okay, so what does this all boil down to? Here's our final rating. We're calling Agilysys a market perform. Look, there's a lot to like here. The business itself is clearly strong. You can't argue with that revenue and subscription growth. And that Marriott deal is a huge potential catalyst down the road. But you just can't ignore the market's concern over profitability. That EPS miss is a real headwind, and we think it's going to put a cap on any major upside for now. The growth story is great, but until it's paired with a clear profit story, the stock is likely to just, well, perform with the market.
And of course, just a quick reminder, this is for informational purposes only. It is not financial advice.